Michael, welcome to Living Off Rentals.
Thank you for having me, Kirby.
Yeah, no, it's great to have you here. I appreciate you taking the time. And I think the timing is actually perfect because we're recording this the week between Christmas and New Year's, but it'll probably come out in several weeks here. And it's we're just starting to get into the tax filing season, I guess. And so as this comes out, I think it will hit people as they're really thinking about it. So I mean, hopefully people have been thinking about it all year, but you know how that goes. So just by way of background, so Michael owns Leonard and Associates CPAs. And this is the firm that does my tax planning and tax filing and bookkeeping. And he was referred over to me by another rental property investor, a friend of mine, Mark Wilton, who's a great guy. And I always tell people that referrals are the best way to find professionals to work with, whether it's contractors or attorneys or CPAs. If somebody has a great track record with other people, I tend to experience that they have the same effect with me. And so that's definitely been the case with Michael. So yeah, I'm excited to talk to you about this topic of taxes, which impacts all of us. But I think particularly rental property investors, there's some maybe nuanced things that we can talk about. So if you don't mind just starting off a little bit with your background and kind of talk about how you got to become a CPA and then what your firm specializes in.
All right, well, excuse me. My father started the company in 1971, and I had no interest of wanting to become an accountant since I was a little boy. But I grew up in it, and real estate has always been a part of it. That was the thing I wanted to do. So, but I ended up going to school, becoming an accountant, and joining my father. But I still wanted to focus on real estate. So we had Leonard and Associates CPAs, but we also had Leonard and Associates real estate and mortgage. I am both licensed as a managing broker here in Illinois, and I'm licensed as a mortgage broker. So we started this company probably about, 20 years ago. And it was all started because I wanted to get into real estate and told my father, and I was working with him, and he said, well, go find some real estate. So being the ambitious young lad that I was, I went here in my hometown here of Oak Park, and I found a 6-unit building. And I negotiated the price of $600,000 for the building. I didn't have any money, nothing to do. I knew I wanted to be in real estate. So I told my dad, I said, I did it. I got the contract. It's a great price. I did all my research. He said, great. He goes, you're going to buy it? I said, I have no money. He goes, here's a Rolodex. Now, that was back in the day when the Rolodex was like this,
Yeah.
So I searched through the Rolodex, and I found a real estate investor, and I called her up. She's still a friend of mine today. Her name's Angie, and she wanted to buy the contract. So I sold it to her for $625,000.
Wow.
So I made $25,000 without doing anything. And I said, wait a second, this is what I want to do. And then I got into flipping, and it was a real great pleasure to do that with my father, because he also did that. He had his real estate license, and he was a big entrepreneur. We had MRI companies, staffing companies, mortgage companies, real estate companies. So he was a big time entrepreneur. And we did the accounting, and we would do the flips and rentals, and it was just a lot of fun. I have a lot. We would go in and do it, and then walking into a garbage dump of a house, I just see potential everywhere. I love that. Some people say, how do you see it? I said, because I can see where this is going to go. We can go out there, have a bigger kitchen, and then you just turn it and you flip it, or you turn it into a rental and have a income over the rest of the time that you're going to have it. So that's really where it came from me. And then I really enjoyed working with small businesses and helping them along the path. It's not a secret, but the answer to everything really is about planning. If you want to get a piece of real estate, plan it, go out there and get it. You might have to look at 100 pieces before you find that right one, but then that's what you got to do, right? If that's where you want to be, it's as simple as that. In accounting, we plan throughout the whole year where you're going to be. You don't just roll the dice and say, am I going to owe this year? Am I going to get a refund? It's ridiculous. As you know, Kit, when you meet each quarter, you meet with your bookkeeper, then you meet with me, and we figure out where you're going. So by the time we get to the fourth quarter, we've already planned. 2021 is already done. Now we're moving on to 2022. We already know what's going to happen in 2021. And that's it in every arena, whether it's real estate, plumbing, construction. I have handled all different types of businesses, actors, athletes. It all comes down to the same thing. Plan where you want to be and go for it.
That's awesome. Yeah, and I want to talk about that planning because it's something that excites me when I understand it, and I understand a lot better now thanks to you. But before we get into that, what made you switch over to becoming a CPA as well? Why didn't you just stick with investing fully full
You
time?
know, here's the deal. Ready? My dad put businesses together 40 years ago that the grandchildren are now running it, and I grew up in there. You know, my dad passed away in 2015, and I feel family in my business.
Hmm.
You know, when I meet them, they talk about, at tax time here, you should see it. People are bringing me lasagnas, pizzelles, all these different cookies and stuff. And it's just, I I despise I gotta tell you the truth, Kirby, when I first became an accountant and worked with my father, and didn't have the action with the client, I was just doing the work. I despised it. I didn't like it. But then all of a sudden, I had a client and I had that interaction, and I got to know them, and there was that relationship, and it was the relationship I really gravitated towards. Anybody can put numbers together, anybody can do what we do, but in this life, it's about relationships, and that's what stuck with me. When I go and visit some of these companies, Kirby, I feel like my dad's here with me, and it's just something that I will. I'm still going to always do real estate. It's always a part of it, whether it's commercial, residential, whatever it is. But bringing businesses together, small businesses, seeing them succeed, seeing them go from a startup to making millions of dollars, or just being able to say, "Hey, Todd, I heard you had a new baby. I just wanted to call and say congratulations on the new addition." When clients come in and they sit down, we talk for about 40 minutes about business and all that, and then another 50 minutes about life and relationships and how their kids are doing and stuff. And I can't give that up. I love it.
Yeah, I think that's kind of lost, that aspect of business, especially when we talk about investing, because a lot of times it's just about dollars and cents. But that's one of the aspects I think that has driven me to short-term rentals, is that relationship. And we just rented out our personal house on Airbnb for over the week of Christmas because we were spending time with family. And so we're like, might as well rent our own house out. And it was a great source of income. And people that stayed here, we were in the area, so we got to meet them and they loved the place. And we almost became friends with them. They left presents for our kids when they left. And there's that whole relationship piece that we could have just left the light on for them and never talked to them. But I think that's one of the draws to a lot of businesses is, you got to make money, but also there's the relationship component of it.
Sure.
That's great.
That's a big deal, Kirby. I remember I had this property and I had this renter in it, and she became a friend of mine. And after a while, as the renter went on, I showed her how to buy it from me. Mm-hmm. And she eventually did that. And she still sends me a Christmas card to this day. It's just, as people, when they think about buying a property or rental, they think it's just too confusing. That's for smarter people. That's for better people. That's for educated people. When, it's easy if you just follow the steps.
Absolutely. Yeah. Yeah. Most of this community is made up of rental property investors or aspiring rental property investors. And for me, it's been super beneficial to have regular meetings with my bookkeeper. And also, having the bookkeeper in your office has been super helpful. I've had the opposite where it's been, a separate bookkeeping service. And I feel like, you guys are in lockstep, which is a huge benefit. But, when people think about meeting with their bookkeeper, I think a lot of times people don't understand what they should be looking at, especially if they're not like a numbers person. They're like, they don't want to look stupid and ask the wrong questions. So, in your opinion, what are the things that are most important for a rental property investor? I guess first off, should all rental property investors have a bookkeeper? And if so, how often should they be meeting with their bookkeeper? And what questions do you think or aspects of their books are most important to understand?
Well, as you know, when we met, I meet a lot of real estate investors, and some of them come in and they have a bookkeeping, but it's all into one. So let's say they had 10 properties, but we're showing the income from all 10 properties expenses. Well, as you know, that's not the way we do it here.
Mm-hmm.
We like to break down, we want to know each property's expense, so we know what's working, right? Because there's sometimes we can look over it, and we got to look over the cash flow. We got to take into the equity that's being built, because there's sometimes when our portfolio, we need to sell some things, and we can't understand what that is unless we are in the bookkeeping. Meaning with your bookkeeper, you know how things are going, you know the cash flow. I mean, it's a simple thing as extra subscriptions being, I mean, Netflix, Hulu, all that stuff. I know a lot of little things add up to a big number at the end of the year. Things aren't being used. People don't know this. I had this one client who had a subscription to Netflix for a property that he sold 2 years ago. I mean, these things need to be looked at, but they're just not, especially when you look at them as a whole. I mean, if I was the captain of a ship, I want to make sure I'm going to get to where I'm going to go, right? If you don't follow that plan, you'll end up somewhere, but it might not be where you want to be. In real estate, what are you trying to accomplish, and follow that plan? If you're not looking at the financials, if you're running a business and you're not understanding what's going on there, then you shouldn't be in the game.
Yeah, absolutely. Yeah. And I think that one of the things that I've noticed with accountants a lot more than any other professional I've worked with is that, you know, they're working with the tax code, which is like this massive behemoth of all these rules and regulations. And some of them are just like, there's not even an answer. It's like, use your best judgment or industry standard, or they don't even address it. So it's very difficult for most to understand. And so I think some of the more challenging accountants that I've worked with in the past are the ones who want to impress you with their, you know, big words and try to make things seem very complex as a way to maybe charge more, or, you know, just to look smarter. But working with you, you kind of break things down more simply. And I think taking complex terms and breaking them down to even where someone like me can understand them, which is a challenge, is I think one of the most important aspects to look for when working with an accountant, so that it can, you know, you can have a system that you can actually use, as opposed to this complex thing that you dread even looking at. So when it comes to simplifying or handling taxes in the most efficient way, are there any like best practices you recommend or can point to for clients that maybe have more success than some of your other clients who tend to struggle?
Well, the way like you said it perfectly, breaking it down so that you understand what's going on. Because if you can understand it, you're going to be better running your business with this real estate. And if I'm to make it over, if it's more complex, then you're not going to know what's going on. You're not going to be able to, because what is it? I'm not running your ship. We're in a relationship, right? So we need to work together. If I'm just yelling things at you to do things, I'm not being very helpful for you, because I need to know more. I mean, there's things I can pull out of you that we can use for taxes that you might have never thought that we can, just by having a conversation, or just by saying, you know what? I heard about Section 179. That'd be really good for me. And well, you know, if you're at a loss, you can't use that. Oh, well, that's too bad. Well, what about this bonus depreciation? Well, you can use that and still go into a negative. And when you start to operate, you say, well, maybe I should buy this then, or I should do this for my property, because that'll help me with my tax liability at the end of the year. And if we don't have these conversations, that's why I'm saying, as you know, I need to meet with my clients at least once a quarter to have these conversations during the year. I mean, after the 31st, there's not much we can do. I mean, I'm just a monkey putting in numbers. But talking throughout the year, that's when we're building where we're going to go. It's the planning, like I said from the beginning, that gets you there, because, okay, maybe I will do this for my building, and then I'll just write the whole thing off because I'm going to have a gain at the end of the year. I mean, these need to be addressed. I mean, people that drop their stuff really out at the end of the year, and that just blows my mind why somebody would do that. It's the conversations and letting the client understand what's going on with taxes and how they can use it to better themselves. Because it's constantly changing. Everything's changing. I spend 2 weeks in continuing education, and then that doesn't even pass. And everything I learned is out the door. It's crazy. I mean, this last month, I spent probably over 80 hours in continuing education. And who knows if that's going to come into it with the Biden's plan and all that. It may go through, it may not go through. We don't see, but we talk about things. Even the politics that comes into real estate. should we take advantage now of this, or are things going to be harder down the line? And let's wait to take that depreciation, next year, because it's going to be harder because all these things are passing. So, I mean, you're not just one thing, but also in real estate, just like you have other businesses, right? Like me, I own real estate. I own this accounting firm. I have a tax resolution company that I own, all of that. And my wife does things. So all of these pieces are in the puzzle for my grand tax return, right? So not only am I tax planning you for your real estate, I got to know what else is going on. Hey, he's got a podcast. He has all this other stuff. All of this is going to go into your tax plan.
Got it. Yeah. So biggest thing is communication, which I think a lot of people don't think they can have. I think a lot of people think, well, my accountant's there at the end of the year to send all my documents and receipts to, and then file the taxes. But it's really, you should have the conversation right now about 2022, not 2021. Here's all the receipts. It's like, we already had at least 4 conversations quarterly about everything. And one thing that you mentioned to me too early on when we were first talking about working together, you said before you buy or sell assets to reach out as well, especially if they're kind of complex or outside the norm of what you're doing. And that's something that I don't think a lot of real estate investors do. They don't think about, is reaching out to their accountant prior to, to signing for a deal to see how is this going to impact me from a tax standpoint, which is big. So you mentioned, yeah. So you mentioned bonus depreciation there, which I think is a huge benefit or can be a big benefit for rental property investors, particularly. Can you kind of expound on that and explain how that works, and maybe a strategy that how people can take advantage of the strategy?
Sure. I mean, just like Section 179 I was talking before, Section 179 basically is you buy a piece of property, you can take the whole thing in that year, but you can't go into a negative, right? Bonus depreciation says you can take the whole thing and go into a negative and have a loss for the year. But does
when
it
you
make
say
sense?
Sorry, when you say take the whole thing, what do you mean by that?
So let's say that you have bonus depreciation for there was construction for a leasehold. Let's say you had a commercial property and you had the whole build out and it was $100,000, and you were going to go into a loss by taking the whole depreciation of that $100,000. You can still do that. Whereas Section 179, you cannot do that. Used to be only, they changed it. You can only take 50% of bonus depreciation. Now it's at 100%. And that's going to go all the way until 2022. And then it's going to go down 20% each year.
I see. Okay. So depreciating so basically, if somebody say is a high income earner, and they want to offset some of their income, they buy a property this year, and they can write off the entire amount, or is it just the entire rehab amount, or what's
right? Well, we're going a little bit too far there.
Okay.
I mean, as you might know, if you're a high earner, let's say if you're married, father, joy, it starts to phase out after $150,000. You can only take a loss up to $25,000, right? Because what the IRS says is this: let's say you make $250,000 at your job, and you have your real estate that's at a loss right now. They're saying, listen, you obviously that $250,000 is your real job. This is not this is passive income. So that will go to the next year if it's a loss, until you either make less money or you sell the property and take advantage of all that. However, if you are a real estate professional in the eyes of the IRS, you can take 100% of all of the losses that you might have through your real estate. And you don't have to have a license. Like I have a license. That doesn't mean in the eyes of the IRS, if you are working 750 hours a year doing real estate, that is considered a real estate professional in the IRS's eyes. And then you can qualify, as you do, as a real estate professional on your taxes and be able to take advantage of all these different things, even if you go into a loss. Now, if you have income, you're gonna pay on the income. But if you want to take advantage of the bonus depreciation and go in and reduce your income, because hey, I have a guy on a W-2, he makes $1 million, right? He's got about 10 properties. He just came to me maybe like 3 years ago. And he's traveling looking for real estate everywhere, constantly doing this. And I added up, he qualifies for real estate professional. So we were able to take all of those losses from all those properties and actually bring his income from $1 million down to about $750,000. Saved him a ton of money because he didn't understand being a real estate professional. So before we get into should they take bonus depreciation, if they're a high earner, we have to find out, can they qualify for a real estate professional to be able to take any of this? That's number one.
So just to recap, a real estate professional what are the rules around it?
So you can look, the main rule is you have to spend at least 750 hours a year in the real estate. That could be managing your properties. That could be talking to your accountant about real estate. That could be talking to a realtor about properties, looking yourself on realtor.com, going through it all. But you just have to keep a journal, and kind of like what the IRS says about taking your mileage. You're supposed to have your car, the book in your car, and then you write each mileage that you go. That was I would say maybe 0.5% of my clients did that. We talked about it at the end of the year. But yeah, you just keep a journal, and that makes sure it's a very powerful tool with the IRS if people don't know about it, especially when you get into it. When you get into real estate and you have all this, because people think, okay, and it happens so much, Kirby. And somebody told me, I get a new client and they say, they told me to get into real estate so I can finally have some deductions. And I say, great, let me take a look. You got a lot of deductions. And I looked to see how much money they made. Well, you and your wife together made $550,000 last year. You can't take $1 of any of these expenses. But my friend told me that I can finally get deductions if I get a piece of real estate. I said, well, your friend should have been your accountant, because you have to understand what you're getting into and follow that plan if that's where you want to go. In real estate, there are a direction to go there, and that's a real estate professional helps out a lot.
Got it. Yeah. And it doesn't, from what I understand, it doesn't have to be you, correct? It can be a spouse who can meet that threshold of 750. Let's say you're working an 80-hour a week job that's all consuming, but your spouse has time and can meet that 750-hour threshold.
If you're married filing jointly,
bring
it in there. Yeah.
Got it. So then all the real estate assets, then all the depreciation from those can offset the income from the high income W-2 earner then.
As long as you guys own the property together.
Got it. Okay. When it comes to entity selection, this is another question that I get a lot from rental property investors. Should I buy it in my personal name? Should I buy it in an LLC? Should I buy it in a corporation? I know it can be situational dependent, but generally what is your advice when it comes to this?
Don't want it in your name. You want to put it, every time I buy a piece of property, I bought a property 3 months ago, I just put it in an LLC. And then what you can do is when you have multiple pieces of real estate, you can get what they call a series LLC and keep adding each property into it. What you want to do is you want to get all the properties. You don't want it to be in your personal name. You don't want, let's say one of your renters falls down, cracks their head open and stuff like that. You don't want to open that up to anything of you personally. You want to keep it within that own LLC. And it's good to do that. I mean, just like businesses. I mean, I don't want my business, I don't want that to affect, my business went down, I don't want that to affect me personally. So we have a separate entity, just like we have a social, we have an EIN number for all of our entities like that. And you want to keep those separate.
Okay. Yeah. And I think one of the big arguments people have to keep it in their personal name is when it comes to financing. So do you see that people own multiple like rentals in their personal name because they have to get that really low conventional financing? Or what do you recommend there?
I mean, you can personally guarantee, like, for example, they ran my credit when I bought this property, but it went into my LLC. So it's being reported against my LLC. I guaranteed it. Now it can get to a point where your LLC or your business will have its own credit rating, and it can do it on its own. But when you're starting a new LLC and putting a rental in there, typically that's not going to be it. You're just going to personally guarantee it. Got it.
Yeah. Okay. Sounds good. Yeah. And I know there's so many lenders out there that are asset-based lenders now that don't care if it's in an LLC or your personal name. And really the rate's not much higher than a typical, mortgage that you would get in your personal name. So I think that's the route that I see a lot of people going these days, to be able to keep it in their LLC and not have to worry about it in their personal name. So one thing that I see a lot with people, especially when they're first starting out, is that they serve their business as opposed to their business serving them, which I think is the whole reason we start businesses. And it's such a foreign concept to a lot of new business owners. They're like pouring everything back into reinvesting in the business. And they never think about paying themselves, or they pay themselves wrong, I think, because they don't understand how they're supposed to pay themselves. So how do you recommend, like, when somebody has a real estate investing business, should they just take draws? Should they set up a payroll? How do you approach paying yourself as the business owner?
It really depends, first of all, on the amount of income that's going in the property. And if there's multiple, like if you own it yourself, you have your bank account that's set up just for that LLC, just for that property, and you just take money at will. I mean, as long as there's enough in the agreement there to be able to pay the bills, and just take it as you will. And just, I mean, what the costs are each month, and you can figure out what you can take. I mean, if you're going to have another renovation or do something, it's not going to be, okay, I'm going to take $10,000 a month. That's going to be it for the rest of the year. You can't think like that, because things are constantly changing. Just like I tell you, what we plan for today might not be 3 months from now, because could be a whole different thing. Could be another tax loophole or whatnot. I mean, it's something that you're going to take. What I do is I look at it as a quarter, how much is in there, and I take whatever I think is necessary, I could take out of there without hurting the company.
And when it comes to taxes on that amount, then do they have to pay a chunk? Say they draw $100,000 throughout the year. Is that what's taxed, or how does the tax work on that, so they know like how much to expect?
Exactly. So when you're involved in that, you have to understand there's a lot of other things there, because you might take $50,000 out of there and then have no tax consequence. Why? Well, you have your regular depreciation. You have section, there's many things that you can do there. So let's say you brought in $150,000 and you only had $50,000 in expenses, and you made 100. Well, you still got to add in all the depreciation that you're doing all there. So that $100,000 is now $50,000. So even though you took 100, you're only taxed on 50 because of all the extra stuff. So that's something you need to go over with your client. Now that sounds all great and everything, as you know, but what happens when you sell the property? Well, you've taken this depreciation, all that. Everyone's like, yeah, let's take as much as we can. Yes, yes, yes. And then it comes time to selling it, and you're like, wait a second. I didn't make that much. I put this much into it. Yeah, but we took the depreciation, and now you got to pay the capital gains. So you have to, I've seen it happen so many times where people, I mean, I just had a woman, she sold her apartment building for $3 million. She bought it in 1976 for $200,000. Now she's 80 and it's 3 million. So before she sold it, what did she do? She came to see me. We went over it and it was fully depreciated, right? There was nothing left there. So, I mean, she had to pay a lot of money in taxes, under $1 million, but she got $2 million in cash. Now there was a talk with that. I said, listen, if you sell this, this is the amount of tax you're going to have to pay. If you don't sell it and hold on to it, and you were to pass away and your children were to inherit that, they would get what's called step-up basis and pay zero tax. So, I mean, there's a lot of things that go on when you're going to sell something, especially when you're older in age and you have this huge tax gain that's going to come there. So I had to have that talk with her before I did, said, okay, this is what this is going to be, because she needs to know that, right? It's a huge tax gain that is available right now. And a lot of people don't know that you can do that. I had this one client, she came to me, it was a brand new client. I felt my heart went out to her. Her mother was dying and she wanted to make sure that her daughter got her house. So before she died, she quitclaimed her house over to her daughter. And what in fact she did is she just gave her daughter her original basis. So she bought the house for $100,000 and now it was worth $500,000. So she just gave her daughter a $400,000 tax liability. Oh. Because people just don't know, right?
Yeah.
I mean, it's just like anything, Kirby. I think I've told you this a billion times. Outside of finance and real estate like this, I don't function in the world. I don't know how to do anything. This is what I know how to do. So the things I don't know how to do, when I talk about my car or my health, I go to a doctor, I go to a mechanic, because these people know what they're doing. I do that in my life. If you're going to do these things, you need to find an accountant. I mean, if you are in business for yourself right now and you do not have a relationship with an accountant, you should not be in business. I'm not saying come see me. I'm saying you need to be with an accountant. If you don't, I don't know what you're doing.
Yeah. Yeah. So it goes back to having that conversation before you take action on these things, and setting it up in the right way. What about it? We're talking about taking pay from your business. What about payroll taxes? Because I've heard about that. I kind of understand it, but where does that play into it when you take draws from your business?
draws isn't payroll. So I mean, as you know, your personal property that you buy and then you rent, it goes on your personal taxes, Schedule E. Schedule E, don't need for payroll. It's just income minus expenses go there. However, if we have these companies like an S Corp that you have as well, we talk about the profit that your company is going to have and then taking a reasonable salary. Because if you are an S Corp, the IRS says that you must take a reasonable salary. So basically we talk, if your company is going to make $100,000 and we would probably give you a third of that as payroll. And if we didn't, and that just went on your personal taxes, then not only would you pay tax on that, but you pay self-employment tax, which is 6.2 to Social Security and 1.45 to Medicare. However, when you do that on your personal taxes, you pay as the employer and the employee. So that's an extra 15.3% of tax on top of the regular tax that you're going, double taxation. That's why people opt to be an S Corp. But then what happens? Then what happens is you're not paying that much into Social Security. A lot of people don't put a lot of faith in Social Security. So I say the money that you save, put into a SEP or put into a 401k for yourself. I tell people all the time, old Kirby's counting on you. He wants to be able to retire. He wants to be able to relax, sell his portfolio and just sit and drink Mai Tais. So you got to plan for that right now because he's counting on you. A lot of people, it just goes by. They keep deferring. When I'm helping somebody, let's say, not pay self-employment tax and their life is going on and they're not paying into an IRA or nothing like that. I mean, life goes by like this. I've seen it happen with my dad's clients. All of a sudden they're getting close to retirement and they have nothing in Social Security and they have no retirement. It's something that has to be planned for because life happens like this. I mean, that's why we have so much insurance, life insurance, car insurance, all these things. If I was to go, my dad would talk, if I was to go like this, my clients would go, oh, that's too bad. He really was a nice guy. But in the back of their head, they're thinking, who's going to take care of my taxes? Where am I going to go? You have to have succession plans for that. There's so many things that you have to plan for because you don't know what's going to happen. I mean, we all have families and things like that. We have real estate. We have businesses. If something was to happen to us, we have to have a plan for that or it just falters, just like anything in life.
Yeah. Yeah. I appreciate that clarification around the difference between an S Corp or being taxed, pass through as an LLC, because either one could be an LLC, correct? I mean, you get to elect how you're taxed as an LLC, but I think
Correct.
a lot of people don't understand the implications of that when they're electing that. They set up an LLC and they're like, oh, I'll just pick S Corp here. And they don't understand, well, now, you're double taxed or you're taxed first as a corporation. And then you have to pay, your own personal income taxes and do set up the payroll and all that. So it's important to understand that, I think, as a rental property investor, and typically it makes more sense to set it up as a pass-through entity. So that I appreciate that. So at this point in 2021, almost into 2022, is there anything that you would recommend looking at for somebody who might wish they would have done some more planning at the beginning of 2021 and are in a situation where they're like, dang it, I am left with what I've got, but is there any last minute tax tips or things people could look at to reduce their tax burden at this point?
I mean, everyone is completely different. I mean, you got commercial property, you got residential property. First of all, you got to know where your business is going. How much money are you going to make this year? How much money is it going to show on your tax return? What do you have that's available to depreciate? Is there something that you could buy right now? Do you need equipment? Do you need computers? Do you need whatever? Remember this, for a bonus depreciation, all it had to qualify for it is 20 years or less of useful life. So anything under that you can take. I mean, that's a ton of stuff that you can do there with equipment and things of that nature. And now's the time, if you buy it, you can have that special depreciation. What you were talking about before is, okay, say you have a property that's closing. Well, guess what? If it closes this week, that's 2021. If it closes next week, that's 2022. So that's a conversation you should be having. Should we push it into 2022 or do we take it in 2021? I got to look at your portfolio. But again, if I look at John Smith, and John Smith has this, and his wife's got another S Corp, and then they have another business here, I got to bring it all together. I might push that out and say, you know what? Let's not close this. Let's close it next week. Those are the conversations. I mean, that's a huge thing, closing right now or next week. I have a client that needs to pull money out of his retirement. Okay, he just needs to do it. He needs to take $200,000 out of his retirement. Now, he was going to pull it all out right now. Okay, that's great. I just said one simple thing. Let's just run a plan. What if you just took $100,000 this week and take $100,000 next week? Well, that means we just split 100,000 into 2021, 100,000 into 2022. We just brought down his liability there, but he was just going to come grab it. A conversation that he needed to have with his accountant. If he just took that, he just made another $200,000 for the year. So that's how it's very strategic how you do these things.
Yeah. I've also in the past I had quite a few long-term rentals, and I would prepay half of the year's property taxes, because they would release those bills for the first half of the year before the year ended, and so I could prepay those in 2021, even though they weren't due till March or April of 2022. And when you own a whole bunch of them in Illinois, which is one of the highest taxes in the whole nation, it makes a big difference. So that's something people could think about as well. Great advice. Awesome. So
on that taxing note, what a lot of people did, I mean, just with the great changes of taxes that happened these past few years, the SALT taxes, where only can take $10,000, as you know, for our real estate taxes now and all that. A lot of people getting into real estate, they don't realize it doesn't work for rentals. For rentals and things like that, guys, we take 100%. That's not capped at 10,000. So getting into real estate, remember, you can take 100% of the taxes, whether they're 10,000, 40,000, or 50,000. You can write it all off. I see a lot of people, they don't realize, like, oh, it's got all $30,000 worth of taxes. I don't want to buy that. I can only use 10,000. And it's just a simple thing that doesn't equate to investment property.
It's just for your personal residence.
It's for your personal residence.
Yeah, got it. So one question that I've had come up several times from short-term rental investors, and this might not be something that you look into a whole lot, but there seems to be a big mystery around different municipality taxes when it comes to short-term rentals, because it seems like some treat it as a hotel or there's separate lodging expenses, and then there's city taxes and county taxes and state taxes, but some states don't have taxes on this. And so what do you recommend in terms of demystifying this for people to get the right information so they can know they're not guessing, and at the end of the year they're going to have this big tax liability?
Well, just as you said right there, I mean, if you buy a piece of property here in Illinois, that's different than buying in Florida. Or if you bought a piece of property in Florida and you have a rental, and then you move here to Illinois, guess what? When you sell that property in Florida, you're going to pay tax here in Illinois. I mean, there's all these things that come into it. So what I would suggest is discover the portfolio and where you're going to go after the properties. As you know, there's certain properties that you want, certain states you want to work with, and certain ones you don't want to work with. So figure out where you want to be, and then have a sit down with your accountant. And then we can go over each rules for each state so that you understand it. Because if I describe one, it's not describing the other. Everyone's different in the whole mechanics, the way it works. So the best way I can explain it to you, Kirby, is that find out where you want to be and make sure your accountant explains to you the different rules and what is best for you and the way you want to work with it. Or you might want to go the opposite way and say, you know what, this is the range I want to work with for real estate property. They would say, you know what, okay, then you're going to work within Texas and Utah and Indiana. Those are the best ones for you to work with. I think going after it that way is probably a better way to answer that question.
Got it. Awesome. This has been really, really great information. I appreciate you clarifying a lot of this stuff. If somebody is interested in working with you or your firm, what is the best way to find out more information?
They can go to my website at leonard-cpas.com. They can give us a call here at 708-456-9122 and set up. What I like to do is set up just an introduction for me to explain the way my process is and the way what you're trying to accomplish, because you want to know something. I said a relationship. It's me working with you. There's that synergy there that we work together. It's not like that with everybody else. There's sometimes where I'll send someone to somewhere else because we just don't have the right say chemistry. I mean, there's certain things that I want, and there's certain things that other people are like, no, this is the way I want to work. If this is what you want to do, then that's just not me. But there's other people that will do that. I just need to. I guess I'm more of a a husband than a boyfriend. I get involved in these relationships, and I want to see it succeed. And I need to have a big hold in the relationship to make sure that we get to where we want to be. And some people, that doesn't work out for. But if you have a goal and you want to get into real estate or whatever business you're in, and you need guidance, I'd be happy to sit down with anybody out there right now. And one of the real cool things, I mean, thank God something cool happened out of this pandemic, because of the way we are right now on Zoom, right? So people in Texas or wherever, they want to find somebody local usually. But I have clients that I've helped that they wanted to get out of Illinois and start a business elsewhere, and I've helped transition them there. They've talked to other business owners and they referred me. So now I'm in multiple states. I mean, I got businesses in Texas, California, New York, Nevada, everywhere. And it's because of this. Because now, wherever you are, you can be on your boat and we can be talking about your real estate portfolio right now. So wherever you are, if you're thinking about starting a business or you're thinking about where you want your business to grow, please give me a call. Michael Leonard here at Leonard & Associates CPAs, folks.
Yeah. Yeah. And the relationship with the bookkeeper too is so key, because Holly, I got to give a shout out to Holly, who I work with. I meet with her monthly at a minimum, and she knows the way I do things. She knows what my goals are and like how I operate and how my expenses flow through and all that stuff. So, you develop that over time too, and it just makes things flow so much smoother. So that's awesome. Well, I really appreciate that. And if people are interested, definitely reach out to Michael, and I appreciate all the information.